to the big picture. And at the height of the financial crisis in 2008, 2009 seems like a very, very long time ago now, but we are still really dealing with and reading from its consequences, with new shocks potentially in China, the sort of Greek tragedy carries on, and just this week CPI has gone back into negative territory. And we're still, as pension funds, locked into that long-term low interest rate environment, which I'm sure I remember people talking about being a temporary phenomenon back in 2008, 2009. So still big challenges for us as pension funds, big challenges in us trying to find return in that environment. So I'm really delighted to be joined by Stephanie Flanders, who's going to talk us through all of that and what the shocks are. It says in my brief note what the challenges are, but I'm hoping we're going to find some opportunity as well to talk to us. So Stephanie, here from JP Morgan, previously with the BBC. Stephanie, you're very welcome back to this conference. The floor is yours.
Thank you very much, Joanne. You think it feels like a long time since the financial crisis. My kids, one of whom was born in the middle of the credit crunch and was the reason why I missed the Lehman's, had to leave it to Robert Peston. It's really sad that he's left the BBC or is leaving the BBC, because I'm not going to be able to make sort of cheap wisecracks about him anymore in the way he's doing my old job. But there is an opening for an economics editor if anybody's fancying a new career. But my daughter and my son, I think they're 7 and 9, and they feel like they've spent their entire lives hearing about the financial crisis, and also particularly Greece. In the middle of the summer, my son actually did turn to me and say, "Mummy, Greece does just seem to cause a lot of trouble. Do you think they should just get rid of it?" So I think that thought has occurred to Mario Draghi and other European politicians. I think there is a real question, which we do face now coming out of the summer, not just about where the global economy is going, but as investors, is it going to be more of the same the next few years? Or something different? Should we be preparing for something different, preparing clients for something different? When I say more of the same, I guess what I'm talking about is not very exciting, in fact, generally disappointing economic recovery, surprisingly low inflation in most parts of the world, continued rock bottom, supposedly temporary low interest rates, but rising asset markets. That's been, if you'd sort of bet on that, and within that, to the extent that you can, been oriented towards risk assets, you'd have done quite well over the last few years, even though there was so much hand-wringing about where the economy was going. And I think with the turbulence in the markets in the summer, one of the questions that I heard a lot from people, CIOs, fund managers, others, as they sat and thought about what came back from summer holidays and sat and thought about the world, that was a question I kept on hearing. Do we need to, they were just looking closer at that paradigm, not quite willing to let it go, not really thinking the world was going to be fundamentally different, but just feeling it was under threat. There was more questions to be answered. Maybe that the change in the cycle felt a bit nearer. So I'm going to think about some of those issues, sort of take a step back and think, what are the questions now? What have we learned in the summer? What does that tell us about whether we are on a different kind of path? I mean, I think the lessons were quite a fundamental one, was that the emerging market world and the developed world are diverging. This is not a reference to DM boots, but that there is now much more momentum some more momentum in the developed world, and actually quite a lot of problems being faced, not just in China, but a lot of those countries that are related to China. As a result of that, even though we've had some good news from different parts of the world, including Europe, growth and inflation are going to be lower than we hoped again. Once again, last week, IMF revising down its forecast for global growth. And the Fed is confused. We learnt that too. We learnt that certainly in the way that they dealt with the September meeting and the decision not to raise rates in September. Sent a lot of conflicting signals about whether they were still on track or whether actually we really we're going to put off the date of a rate rise in the US and possibly the UK forever. What do I think the watchwords should be now? How should investors think about it? Well, I think the central bankers should probably have slightly higher expectations of what they're going to get from the developed world. I don't think that we're going to be completely derailed by what's happening in China and other places. I think we can carry on having a recovery, just as we did in the late 90s. The horror story of, is it going to be like the Asia financial crisis? I was sitting in Washington in the US Treasury handling that, and it did seem like a very shocking and world-threatening financial crisis at the time, when we were going off and trying to help prevent Korea from defaulting and other things that you can do if you're in the US Treasury. But actually, if you look at the numbers, the global growth numbers, and certainly growth in Europe and the US in that period, that shocking period of crises, it's very hard to spot the Asia financial crisis. The developed world did okay, even when all these terrible things happened. So I don't think we should be expecting a recession or another crisis, but I don't think investors, even if we're not going to get a recession, and maybe I don't think we're going to get a full bear market in the near future, we shouldn't be expecting to get the kind of returns we had in the last few years, and we should certainly be expecting to get more volatility, or at least as much as we've had over the last few months. This is one of those charts I would never have dared to explain to Jeremy Paxman. He would have been very rude about it if I'd been on Newsnight, but I know you guys are big enough to take it. We call it a heat map. And it has the purchasing manager indices. Some of you are familiar with the guide to the markets that we produce every quarter. This is one of the most popular charts, actually, because it's sort of telling us, if you've got a number for that purchasing manager indices that's over 50, that's associated with an expanding economy. We have the higher numbers in green and the lower numbers in red. If you'd looked at this a few years ago, you would have seen all the red was in places like Spain and Europe, and indeed other parts of the developed world. And the green, the good spots in the global economy, were all in the emerging market economies. That's completely shifted now, and that's what I'm talking about when I say that there's a diverging pattern. And you've got Brazil and Russia now in recession. You've got India actually not doing too badly, but China obviously the source of all this bad news. But look at where the green is. The green is in some of the crisis economies that we thought might never recover, not Greece, because of their wonderful political journey they've had over the last year. But Spain, Ireland, all these places actually growing quite fast. So in a way, it's back to normal. Maybe we're going to have some financial crises and bank failures and debt crises in the next few years, but they're going to be where they normally are, which is emerging market economies. They're not going to be in the advanced economies in London and New York, which is what we had to deal with in the crisis. Should we really panic about China? Well, I know that I have a room full of professional financial folks here. I don't think that you would have been that surprised if I told you at the beginning of the summer that China was about to have a big bursting of its equity market bubble. The fact that a market that went up that high, that fast, was about to fall quite dramatically would not really have surprised anybody, especially since it was backed by quite a lot of margin debt. So when that started to happen in the summer, I don't think the world was really that perturbed. And we also knew that it wasn't likely, that big fall in the market wasn't likely to pull down actually the Chinese economy, because households only hold a very small proportion of their assets in equities in China. It's never really been more than about 10%. It's very different from here. They still hold their assets in cash. And the other thing that happened, this shocking depreciation of the renminbi, the currency, on August 11th, well, we kind of actually expected them to do something like that, though maybe not quite at that time. Because remember, the Chinese have had their currency linked to the dollar for the last few years, at this time of great currency wars, where everybody else has been madly trying to depreciate their currency, get more competitive against the dollar. China's been tied to this super store-away dollar, going more higher and higher, getting less and less competitive. Most of the major currencies in the world are actually not far from where they were now in 2006 in real terms, about 5 or 6% within that. China's about 36% stronger, appreciated in real terms, and that's making their exporters less competitive. So we knew they'd do something about that. So why were we bothered? Why did global markets get so freaked out by this? Well, one was, did it tell us there was something terrible happening in the Chinese economy that we didn't know about? And that's important because emerging market economies are very dependent on it. And the other, I would say even more important, again slightly going back to my time in the US Treasury, is we were rather panicked by the fact that they seemed to be panicking, that they had just handled all of this in an incredibly cack-handed way. And then it made us realize, they were madly intervening in the stock market. They'd like the stock market forces when it was going up, not so much when it was going down. Madly trying to prevent stocks from being traded. When they announced the exchange rate thing, it was all very inconsistent, and they kept saying that they thought they controlled the currency, it wouldn't happen again. Just sent these warning signals to a lot of people, because it made us realize, actually, we'd been giving these guys the benefit of a lot of doubt the last few years. You will have been at conferences where people maybe talked about China and said, oh, they've got these imbalances and they've run up this debt and they've got this big structural transition to do and nobody's ever managed to do this, blah, blah, blah. And almost always in those presentations, whether tacitly or explicitly, we've tended to say, but you know what? These communists, they seem to actually know what they're doing. They seem to always pull it off. They seem to be able to handle this stuff, and every time we thought they were going to fail in the past, they've somehow pulled it off. So we think they'll probably manage this. And then we see them in the summer dealing with only a small part of the challenges they face, and doing it really badly. And I think that was quite a good reason for people to be nervous. But of course, the other key thing was this question about the economy. What does it tell us about the economy? Should we be more? Is there going to be a hard landing in China? Some people say, by some definitions, they've already had a hard landing. Really depends on which part of the economy you're looking at, though. The old industrial side of the economy, churning out manufacturing goods, heavy industry, well, that has fallen very substantially over the last year or so. In a sense, that has had a hard landing. But there's another part of the economy which is actually growing very fast, the services side of the economy, retail sales, Alibaba, delivery, you talk to delivery companies, taking off. Because at the same time as this slowdown, they've actually got this big structural change in their economy. The services sector that we're not very good at measuring has actually got much bigger very quickly in China. And you see that as an old friend of mine from the Financial Times who wrote a great piece from Shanghai. She has 2 adopted Chinese children, and she wrote a great piece about the caravanning parks that are now in the outskirts of Shanghai and other major cities in China. The middle classes in China really into caravans. They don't want to go anywhere. They want to be in the caravans that are just parked on the ground with no wheels. But they're incredibly popular, and they wax lyrical about the loos. They think the loos in these caravans are absolutely fantastic. And in fact, the Chinese authorities are renovating 54,000 toilets at public parks alone. You wouldn't, and she said herself, walking around this place, you wouldn't think there was some terrible hard landing and slowdown in China. So it's not all bad, but it is definitely pulling down the numbers for emerging market economies and hurting lots of parts of the emerging market world that have done very well from this growth that China's had in the past. And that's why emerging markets are struggling. They've had several engines of growth over the last few years. One of them was commodities, and the commodity prices fell again this year, massively, thanks to the falling demand from these traditional parts of the economy in China. Trade, being part of the new global economy, has been the other driver of their growth over the last 20 or 30 years. Because trade's been growing faster than the global economy. That's been about globalization, these crazy supply chains that you find out about when you're in the supermarket. My daughter, I like making sort of homemade cakes for my daughter when I get a chance. She wants the pink Peppa Pig ones that you buy at Tesco's, and you look at them, and they're made in England, packaged in China, with no eat-by date, which is the thing that makes me most worried. There's no limit on when you can eat it. But that's the kind of thing you think, that's crazy. That's sort of globalization on steroids. That it actually makes sense somehow to make a cake, send it to China to be boxed, and then bring it back. I kid you not, if you look and see in the packet anyway. But that kind of stuff is actually unwinding. So we're not getting the same kind of trade. And we also seem to have a rather surprising kind of cyclical slowdown in global trade. So then trade isn't doing it. So all these countries, not just in the emerging market world, who were trying to export their way out of trouble in the last few years, well, they haven't actually done so well. It's domestic demand that's actually been how countries have been able to grow in the last few years. And actually, that's why the UK has not done so badly in the US. We may have had all this terrible consumption-driven growth, domestic demand, but it is domestic. We've created our own demand. We haven't been trying to get it from other people, which is what a lot of other countries have tried to do. And if you see, emerging markets have failed on the domestic demand front, and that's why they are struggling. But, you know, we have good news in other places. We've got good news in the UK. It was the Old Times this morning. I was on the Today programme talking about George Osborne's fiscal charter, except for I didn't have to be balanced. I actually had a view. And various people tweeted saying, how can you let Stephanie Flanders state her opinion? And they were commenting back saying, well, she can do what she likes now. But we have quite a nice combination at the moment, which just some of us, we sort of feel this is too good to be true. We have productivity growing, output per head, which is the thing that I was obsessed about in my old job. I'm still obsessed about. We'd had this real shortfall in productivity over the last few years, which is really important because it's the only way we get richer. It's by making more stuff with the same number of people. Productivity has actually picked up at the same time as you have real wages finally picking up. We're actually generating some upward wage movement after a record period of falling real wages. Now, that may not feel that great. You know, we're still not looking at very dramatic growth. We're not having a lot of catch-up growth after this long period of slow recovery. But these two things are very good news because it means we've got more money going into people's pockets, underpinning the recovery. You can continue with that consumption, that domestic demand-driven recovery, we hope. But it's not costing businesses anymore. We don't have to worry too much about that wage pressure because they're actually, those workers are being paid more, but they're also producing more. So it's not necessarily hitting company margins. And we're also getting better news in Europe. And that's another sort of, in a funny kind of way, the bad news of the last few months from China and even actually Volkswagen. In a funny kind of way, it's been bad news mainly for the core economies like Germany, countries that are very dependent on the trade and on the manufacturing side, on all of those things. Actually, the periphery, the crisis economies, are doing rather well. You can see how sentiment's gone up in Italy and Spain. It's really only Greece that's the outlier. They were actually growing. They were actually doing as well as Spain at the turn of the year, and then Spain's carried on going up, and Greece fell off a cliff after its election and all the shenanigans there. But it's sort of interesting that you've had for years the core economies were the ones that were growing faster. Now it's the periphery. I was in Madrid a couple of weeks ago, and my colleagues complaining they can't get restaurant reservations. There were no such complaints a year ago. So I think the wild cards in Europe, as ever, are not so much the economic ones, the recovery, but what happens to politics in the meantime. You know, we've had, the top left, we had the sort of crazy characters in Greece. In fact, Varoufakis, who you all used to see quite a lot during the financial crisis this summer, the finance minister, he's been replaced by someone called Euclid, which enabled this brilliant sub-editor to think of the headline, "Here's looking at Euclid." The Irish Times, that was, but I think it was stolen by a few others. In Italy, as you do in the UK, we have mainstream parties being rejected, mainstream leaders being rejected, and others coming into the fore. Believe it or not, he's the one who's the former clown. This is the other Matteo. Matteo Renzi is the very successful reforming prime minister, still doing quite well, but his competitor in La Liga is this other Matteo. I wonder what it would do for Jeremy Corbyn to do a photo shoot like that. I suspect we won't find out. But I showed this. Usually it's very easy in America to sort of excite people because you can show pictures of these colourful, crazy political characters to American investors who think, wow, these crazy European politics. I didn't really get much of a reaction last week, and I suddenly realised that they just had the Republican candidates debate. And, you know, none of these guys really are any measure for Trump and indeed some of the other candidates. So, but, you know, we have that theme everywhere, right? Rejection of mainstream politics. I think there's a political wild card now everywhere, even as maybe the economics gets a bit more boring. What's going on in the US? Well, I told you the Fed was confused And I think the unfortunate thing was they're so transparent, they want to be communicative. They communicated their confusion quite effectively to the markets in September, and then we all freaked out and said, gosh, now they've moved the goalpost again. What's going on here? The truth is they do face quite a difficult situation. You look at the unemployment rate, it's well below the long-term average. Looks like a decent time to raise interest rates. Certainly seems like a crazy time to have record low interest rates. But the wage growth has still not happened. They've actually still got less wage growth, less signs of upward movement in wages in the US than they do in the UK. So I think this is, they're weighing a lot of things. They're weighing the global situation. Is there going to be another negative shock to America from China and from elsewhere? They're weighing the fact that they keep on getting, their economy keeps on getting squeezed by the stronger dollar. In a sense, they've had, instead of a rate rise, they had a rise in their currency, which has tightened conditions domestically, and the Fed are quite aware of that. I think that makes it more doubtful whether you'll have a rate rise at the end of the year from the US. But if the economic data continue the way they have, and we feel a little bit more confident about the rest of the world in a few months, I think it's quite possible that they'll raise rates. They certainly would like to. And then I think it becomes easier for the Bank of England also to think about that. But they're not comfortable yet, and I think that tells you a lot about where they see the risks in the global economy. Of course, for all of us, certainly for most clients, the most important thing is not really whether it was September or December or February. It's the pace of rate rises that we see after that, and where does it stop? Where do they think is the neutral sort of stopping point for rates? Notice that blue line there. It's really the rate expectations just keep coming down. That was where they were only 3 months ago when we did our last guide to the markets. And they've come down again. Maybe they'll continue to come down. I think, as I say, what's most interesting is the long term. And long term, I think it seems pretty clear that rates are going to continue to be what we would consider to be exceptionally low for a long time. And in fact, the Bank of England's done some rather interesting research on that recently. They now think that the long-term neutral real rate for the world is probably going to be closer to 1. So 4 percentage points lower than it was in the past. That's a hell of a change, and that's actually changing for structural reasons, not because of the crisis. Some of you who've had me speak before know that I used to be asked to do this, not for the Today programme, but for the 6 o'clock Radio 4 news. They would say, Stephanie, we've got a big news day, we've had this big story, our reporter's going to tell the story, but we need a WDM from you. 1 minute telling everyone what does it all mean. I'm going to probably take a little bit more than a minute. One lesson is that search for yield continues, at least in the sovereign world. This exceptional period of low rates, I don't think it's going to go anywhere, not least because it's actually been going on for a long time. This is not just to do with quantitative easing. This is a very long bit of history, right back to 79. If you look at, that was the beginning of this period of falling nominal interest rates, long-term yields. For that first part of the period, it was really about getting inflation out of the system and then teaching the bond markets that inflation wasn't going to come back. So that was partly about yields catching up with the fall in inflation. Paul Volcker had come into the Fed and said, right, we're not actually, central banks are going to really care about inflation now. But this period in the noughties, that was when we had real rates continuing to fall and staying very low, even when the economy was doing okay, even when the Fed was raising interest rates. Remember, that was the sort of conundrum. So this isn't just about quantitative easing. It's not just about Ben Bernanke or any of these people pumping money into the economy. This is a long-term structural change. I think it's not going to go anywhere. So that makes it harder. We still have to be plugging in lower returns, I'm afraid, into all of those calculations. And from a sort of more opportunistic standpoint, it is interesting now that you have a big rise in credit yields, particularly in high yield, which certainly in my world people are getting quite interested in, people who didn't see a lot of opportunities in credit when when spreads were so low a year ago. They are seeing opportunities there, but obviously there's risks that go with that. There's a general view, the feeling that this panic in the summer over high yield and elsewhere has been overdone. That if you don't think there's a recession coming with a big rise in defaults and other things, then arguably these yields don't make sense. So then maybe there's some opportunities there. But it depends quite a lot on that calculation. And if you are able to be in equities, I think we'd say certainly a conclusion they're cheaper than they were a few months ago. And I think now getting closer or even below their long-term averages. So if we think that was maybe a bit of things have got a bit ahead of themselves, particularly in the US, in the first part of the year, well, that has definitely come off. Of course, people now ask, well, does that mean, is this the beginning of something worse? Is it a bear market? We don't think so, because we think if you go through history, you do need to have a global, you need the business cycle really to kick in, to have a proper global recession, or at least a recession, to have a true bear market, a fall of over 20% or more. Or sometimes you need excessive valuations, but we don't think markets look really expensive either. But that doesn't mean you're not going to have corrections. And this is one of those charts we have in the guide that's very popular with a lot of people because it just reminds us how volatile the markets are just normally. This is the grey bars are the calendar year return on the FTSE going back 29 years. And you can see in most cases, and something you would all know, is positive, overwhelmingly positive. But the red dots are the maximum intra-year drawdown, which, in common language is just at any given point, what's the biggest gap between the high point of that year and the low point of that year? How far below are you where you were at some previous time in the year? And they're pretty low. I mean, we forget, actually, the median drop in the course of a year is on the order of 12%. Now, that's exactly what we had in the summer. So you could say what we had in the summer was par for the course. And it is actually what you're paid for if you're in these risk assets. That is kind of the point. You get those higher returns because you're putting up with this kind of volatility. So just to summarize, exactly the same as what I said at the start. I mean, I think the world hasn't fundamentally changed, and that's good news if you're thinking in terms of, are we imminently about to go down another hole or about to see a big bear market? It's rather bad news if you were hoping that actually the economy would be feeling more normal by now, that we'd be closer to thinking about higher interest rates, closer to thinking about inflation. I mean, I have to say, when I'm standing here talking to you about the risks of inflation, that will be a very happy day for me, but I don't think that's going to happen yet. But we're very welcome to have some questions.
Indeed. Thank you very much.